viewers, welcome to another episode of the Solve to Evolve podcast. This one is a very important one as we come towards the end of another financial year. How exciting. Today we're just going to cover what business owners and individuals should be considering or thinking about when it comes to year-end and tax planning for the year-end. So
Phil, as we approach year-end, what should business owners be doing before the end of the financial year?
So many things, but the most important things that the business owners should be thinking about is firstly, making sure your numbers are up to date so that you can compare your actuals versus the budgets you've already set and understand why there are variances. Have you spent too much? You made bad decisions throughout the year, or what happened through the year? You have an understanding of the variances. The second thing is, if you do have existing debt, think about how you can manage that better. Can you refinance that to get a better rate, especially during this time? Can you speak to the lender to work out a better arrangement, or even the ATO if you have ATO debt? The third thing is, if you're running a business with inventory, think about writing off or doing a stock take and then writing off any obsolete stock and adjust the inventory levels to the correct levels, because at times, there can be a mismatch to what you have on hand versus what's in the books. And then the fourth thing, you probably want to be speaking to your tax accountant to think about how you can maximize your deductions and potentially defer any income to the next financial year to reduce the amount of tax you have to pay.
I think you should always talk to your tax accountant.
Yeah, if you're not talking to your tax accountant at least once a month, then you're probably doing something wrong. Or you might get, come year end or tax time, you'll be caught with your pants down.
No one wants that.
No.
And what should business owners be thinking about moving into the new financial year?
Well, new financial year, as they say, new year, new me. It's about
financial year, new me.
That's right. It's about now setting goals for the next financial year. So you set goals for the last year. All right, you may have achieved them, you may have not, but can pat yourself on the back to say, hey, I've progressed. This year, set new goals, make sure that they're clear, measurable, effectively SMART. That's the acronym for it. So SMART, specific, measurable, achievable, test my knowledge here. Realistic, yeah, thank you. And time. So time they're really, cool. So SMART. So when you do have those goals set, you want to make sure the strategy is aligned as well. So, Jono and Chris, we've done these sessions before where we've sat down, thought about the goals that we want to achieve for the calendar or financial year, and then really drill down in detail to work out what strategies we need to implement every month or every week to make sure we are achieving those goals come year end. And then the third thing is to update your budget or your forecast based on the goals and strategies that you've set. So if you've set all these things, what do the numbers look like? Can it happen? Will you still achieve a profit? Because if not, you need to make those adjustments to do so.
So what about from an operational perspective, Phil?
Yeah, so from an operational perspective, if you are a business owner, you should always be working on the business. Otherwise, you end up creating more of a job for yourself. And then why are you in business? You're effectively a sole entrepreneur. And the reason why that's important is because if you're not working on the business, if you go down, you're screwed. Your family's screwed. So the first thing is think about leveraging technology out there, AI, ChatGPT, whatever specific systems there are for your business. Implement that to make sure that it's less labor intensive, or there's not a requirement for you to be there, or there's less of a touch point, right? Review your processes to make sure that they're streamlined, they're efficient, especially in areas, your invoice, your back office, your finance team, your administrative things, potentially your marketing as well. Streamline those first, the back office, because really that's important, but it's not value add. It's not seen as value add, right? But it is still important. And third, think about reinvesting profits back into the business to grow the business. So you might be going, okay, we've made X amount of profits. Let's allocate, whatever amount it is to marketing because we want to generate more revenue, generate more leads for the business. That's it for me. Business owners should be thinking about those things before the financial year, but also thinking about those things for the next financial year to make sure that they are progressing and they are actually building a business.
So, Jono, from a tax perspective, what would you say business owners should be considering as they head towards the end of the financial year?
Yeah, so 3 main things came to my mind when I was thinking about business owners and business owners running through a company typically. I think first thing, if you've taken drawings from your company, so you have what's called a Division 7A loan, which was spoken about in the past, coming up to 30 June is the time you need to make sure you've made a repayment on that loan. So there's a particular calculation that your accountant or advisor should do, and they'll tell you in order to not get taxed on that loan, you need to make this payment back into the company. So typically you make a payment, it's similar to a mortgage payment. There'll be a principal and an interest component, and that's making sure that you're not getting caught out with bad tax treatment on that loan. So that's the first one. The second one is sort of tied in with that, but a related one, and that's to look at your profits and consider paying out dividends if you're a company, or trust distributions for if you have a trust. Some people run their business out of a trust. So coming up to year end, you need to look at what profits are there, what have we paid tax on already in the company, and can we pay out those profits to clear them out of the company? And there's tax reasons for doing that, but it's also a good hygiene for your company, and it protects those profits by taking them out of the company, putting them in your hands. So it's important to look at that coming up to 30 June. And, typically, we all know some accountants in practice, and I've done it in the past, is you do that exercise 6 to 9 months after year end when you're doing the tax return. But the best practice is to look at that before 30 June and say, yep, we're going to declare this dividend and pay it out. And that's going to make sure that if you pay tax in your company, you're getting your tax credits here.
Yeah, you are doing that before 30 June, John.
Yeah, correct.
Yeah. Well, look,
Freudian slip there.
So I think a couple other points that business owners should be considering as well is, prepayments come year end. Maybe you can consider prepaying some expenses now to maximize your deductions now. But also, I think deferring income. So there might be business owners out there that might get a big down payment come year end. Well, defer that income to next financial year. Well, sorry, the down payment really isn't considered income, is it? It's a prepayment or a customer deposit.
Yes.
And so,
yeah, so it'll depend on your accounting. But yes, I mean, with the dividends, you'd probably think about deferring that to the 1st of July for this financial year because of tax rates. So the tax cuts blocks you go into that in more detail, but they're changing in the next financial year. So you probably want to, if you can, defer some of that.
It's going to be more favourable for the individual.
Yeah, correct. Absolutely. And lastly, just, a keeping house recommendation is make sure you've lodged your tax returns for your business, your trust, your super fund, any entity that you control, because I can definitely foresee the ATO getting a bit more aggressive and they're already, refusing interest remission requests, late payment.
They have been
penalties.
Aggressive, yes.
Yeah, they're applying them, and unless you've got the best reason in the world, like there was a flood or a fire or, your computer hack or something like that, unless you've got a good reason, they're not going to consider
or the six
letting
Ds.
you off.
There's a number of Ds that can apply, and they can apply directly or indirectly.
6 or 7.
There could be several more than 5, but the 5 that I go to are divorce, depression, disease, disasters, so natural disasters, flood, fire, and earthquake or whatever it may be, and dismissal. So a lot of people get dismissed from a job. Takes a while to get back on your feet. So there are other Ds. I think depression. There's a number of other Ds that don't.
Yeah.
But if you're indirectly or directly affected by any of the Ds, you'll tend to get concession from the ATO.
Yeah, there's strong reasons, but you don't want to have to rely on that.
It can't be
to get out.
Network.
No,
That's not flying anymore.
Well, my accountant sucks.
But it is an important point, which you called out it, but it is an important point because during COVID, they were very softly.
Yes.
It's not the case anymore.
Yeah, clients are getting chased up for, even two quarters outstanding, for example.
Debts have been revived decades ago that I've had clients call me about and say, what is this? What is going on? It's caused quite a lot of problems in the tax community between advisors and the government at the moment. It is a trend that's worth paying attention to.
The kid gloves are off and the boxing gloves are on.
Yes. So obviously make sure you are lodging on time because they are now going hard with the interest charges on any debt that is there, but also land lodgement penalties.
Yep.
We've talked about the business owners, what they should be doing at financial year end, but also from a tax planning perspective. Bloxy, let's talk about the individuals out there in our audience. What should they be? What is financial year end tax planning if our viewers don't know about it?
Yeah, so for the viewers out there that are working a job, or mainly individuals, might be a professional, year-end tax planning means legally organising your affairs to minimise the tax that you pay. It's very important to distinguish that from avoidance or evasion. So planning is legal and really required in a high-tax jurisdiction like Australia. Taxpayers, the individuals, should be careful of anything that sounds too good to be true, particularly towards the end of the financial year. So we're in the last quarter now. So if you hear about, for example, any plans that involve agriculture, forestry, the trees of some kind, where you can borrow in a round robin style an amount of money from the manager, who then gets repaid that as a management fee. You get a big tax deduction up front. You really should check if there are any class rulings in relation to those products, because they can tend to, if it sounds too good to be true, it probably is.
Or if your workmate has told you, hey, you can do X, Y, and Z.
Has said, I did this and you can get on board. Please take it with a grain of salt. It's not always what it's cracked up to be.
Yeah.
Backyard tax advisor.
Oh, they're the best, aren't they?
And Bloxy, what about specifically this financial year that people should be aware of?
Yeah, thanks, Jono. So there are a number of things that people should be aware of at the end of this financial year. So the tax rates are changing. So as from the next financial year, which starts on 1 July 2024, individual tax rates will be going down. That's what's called the stage 3 tax cuts. You may have heard about it in the media. That's the first thing. So next year, you will generally be getting taxed less than you are this year. Another big one that I'll come back to at the end is that the Sun is setting for the first time on carry forward concessional headroom deductions into superannuation. So you may recall back to an earlier episode we did, or even back to the days of Turnbull and Morrison when they were PM and Treasurer, respectively. They came up with an idea to allow people to make up their concessional super contributions, but there was going to be a 5-year time limit on your ability to do that. So at 30th of June 2024, this is the first year that time limit will apply, and it will apply to any carry forward concessional headroom that individuals may have from the 2019 financial year. So it's very important to log onto MyGov, link your ATO accounts to your MyGov profile, and just click into the super option, go down to carry forward headroom. If you're eligible, there will be a table there that will clearly show you how much you need to put into super before 30 June of 2024. You also need to fill in a form called a Notice of Intent to Claim. You give a copy to the trustee of your super fund and another one to your tax agent so they know to claim the deduction in your return. There's another thing that may be changing, so that you may recall that through the COVID era, you could deduct practically anything on a depreciating asset that you bought for business purposes.
Up to any value.
Basically, there's temporary full expensing. That's over. So now the limit is $20,000, but that may change. So we really need to wait for the May budget to see what happens to that. But you should expect that the number will go from 20,000 down. And again, we need to wait to see what other surprises are revealed in the federal budget, Jono, to see what else that we should be talking to clients about. Typically, we talk to clients in kind of after the federal budget, to middle of June, to give them still got a couple of weeks to make changes if they need to.
Yeah, that's very important. So obviously, whatever comes out of that budget, I believe it's due to be released beginning of June, I think it is, or end of May.
May?
Yeah, May is typically the time.
May, yeah. Okay.
First Tuesday in May? Yeah.
But when it does come out, we'll definitely do a breakdown and highlight the key takeaways from that. Now, Bloxy, what are some things that the individuals can do to manage their tax?
Yeah, so first of all, it really depends on the individual's circumstances. So in some cases, individuals may want to increase their income this year. So in other cases, individuals may want to decrease their income. So a typical client or a typical taxpayer who may want to increase their income is somebody who's going for a loan. So if you want to get housing finance, you want to show that you have more taxable income so that you can borrow more money, but the loan will sail through. You should speak to your brokers and your bankers about that before year end. So in other cases, you may want to decrease your income this year. So for example, a lot of situations that I see are where you'll have a female client who may be higher income, who knows that she's going to go on maternity leave next year because it's hard to be half pregnant. If you know that's what you're going to do, then you are aware that you will be taking time off work next year and earning significantly less money for the next probably couple of years, in which case you want to delay the derivation of your income from this year. You want to push it into next year.
Yep, when you're off work.
So for those who want to increase income this year, they may want to bring forward a bonus or a promotion. They might want to delay donations or depreciable asset purchases. And they may want to invite discretionary trust distributions, for example. And for the professionals out there, whatever field you may be in, you may want to issue your bills before 30 June if you're an accruals taxpayer. For those who want to decrease their income, they may want to do the opposite. So there's all those standard things in reverse: delaying a bonus, deferring or splitting discretionary trust distributions with a low-income spouse. And if you're a professional, billing after 30 June, sending the bills out after. But the really big one that we want to focus on today, or that I want to focus on, is the carry forward concessional headroom deductions. It's really important, guys and girls, that you go out and look at whether you're eligible. So you have to have under 500,000 in super the previous 30 June. And if you are eligible, how much you need to utilise before 30 June 2024, because the sun is setting. So that is a very important point.
That's a very important point. And ultimately, if you are in a position, if you do have the cash and you're in a position to make that concessional contribution up to the headroom for that 2019 year, that's just ultimately going to be beneficial for that taxpayer because they get that tax deduction for that personal contribution.
That's right.
Yep. And it's typically going to be a high income person who's probably, 35 to 50. You'd probably say, if their super balance is under 500.
Being ageist, yep.
Yeah. In general. Yeah, maybe even 35 to 45 is probably the key bracket there because, 5 years ago, maybe you weren't earning the same as you are now. Your wages have gone up and you got a little bit of cash. Those are the people who are going to be best placed to take advantage of that one.
Yep. Question for you, Blocks. That's for super. What happens if a client comes to you and says, I don't want to contribute or use up the headroom? What else could a taxpayer consider for tax, to reduce tax?
So probably the biggest one that individuals could also think about is how to plan for capital gains tax at the end of the year. So the key to CGT planning, whether it be book squaring or any other form of transaction-based tax planning, is to understand your balance sheet. So where there are embedded capital gains or capital losses, and then how much throughout the year have you realised in terms of capital gains or capital losses, because they're offset against each other under the method statement in the tax law in the current year. The individuals will probably want to trigger gains in low income years. So for example, if someone's on study leave now and they know they're returning to work next year, they might want to trigger some capital gains if they've got embedded capital gains on assets sitting in their balance sheet. Another really important thing to understand is when capital gains occur. I've had a client before who signed his first disposal contract on 1 July and his last disposal contract on in the middle of June. He didn't realise that they were both capital gains in the same income year. So staggering your capital gains tax triggers is very important, and that comes back to talking to your accountant and understanding what the trigger point is for capital gains. Triggering gains to utilise carry forward or current year capital losses is an important skill. In the share trading or financial instrument trading world, it's called book squaring. there are some pitfalls to it. You have to be careful that you're not engaging in what are called wash transactions, selling and buying back. But putting that to one side, book squaring is a legitimate practice which happens every year. Taxpayers may also want to trigger a loss to offset current year gain. So if you know that you've got a big gain and you know you've got a ton of embedded capital losses that you're happy to let those assets go, you need to do that before 30 June. Taxpayers can also invite discretionary capital gain distributions to themselves if their tax profile is favourable. Again, this comes back to if you have a family group that has a number of different individuals in it, you may want to talk to the trustee, or you may be the trustee of the family trust, and you may want to stream capital gains that have been triggered in the year to the beneficiaries of that trust who have the tax favourable profile.
Yeah, that makes sense. I think another thing that you didn't mention, but taxpayers that do have investments, they probably want to consider holding that asset for longer than a year so that you get access to the 50% discount rule.
Making sure that you're holding your assets for longer than 12 months is important for the discount, as is
especially with property, right?
Yeah, property is a big one. Shares can be a big one too.
Yeah.
There's a lot of volatility in the mining sectors, around uranium these days, or lithium, and also holding your dividend-paying shares for longer than 45 days before claiming the franking credit.
Yep. And inviting those distributions, you're having that meeting before 30 June, just to be clear.
Oh, yeah.
That's
correct. And you're signing the distribution statements before 30 June as well.
Yeah, that's best practice.
Excellent. That's all we have time for today. Hopefully you guys got something out of this episode. Please, if you do have any questions, contact us on podcast@solveaccounting.com.au. Otherwise, please follow us for more episodes. Thank you.